Pipeline stocks, or MLPs, are depressed. The problem is the cuts in distributions. Not enough people talk about this, but the fact is that on AMLP, the biggest ETF that invests in MLPs, distributions are down 34% since 2014. This is a sector that attracted investors for income, and the result has been a huge loss of trust. And the result is that investors just don't trust the yields that they see today. Even though a lot of that cash has been redirected towards growth projects and those distribution cuts didn't reflect bad business conditions, nonetheless, to an investor who bought something for yield, a lower yield is a bad thing, even if in the future there'll be better growth because of new projects. I think what the market needs is a different way of looking at the valuation of pipeline companies when they're putting so much more money into growth projects. And one example we use is if you own a building. Suppose you own a rental property and it generates a 13% yield after you've paid all of the costs of owning it, you've paid the property taxes, you've paid the cost of maintenance, put aside money to replace the elevator. Suppose you've got that 13% yield. And then suppose you take that building and you say, I'm going to take the profits from that and I'm going to move 8% of that over to this new investment. So that 13% yield drops to 5% after you've invested in this new building. What's the original building worth? You're still getting that 13% yield. Just because you've redirected 8% to a new project doesn't change the value of the existing building. This analogy really works with pipeline companies. Distributable cash flow is money that a pipeline company generates after they've paid all their maintenance capex to support everything they own, but before they pay for new projects. Free cash flow is what's left after they pay for those new projects. The market should be looking at valuations based on this distributable cash flow, which in the case of a building will be called funds from operations. But instead the market is focusing too much on the free cash flow numbers. The distributable cash flow numbers before the growth projects are attractive. The free cash flow numbers are not. The market needs a new way of looking at valuations. The example I've used is from Kinder Morgan. We think in 2019 they'll have a 13% yield on their existing business, distributable cash flow, but a 5% yield after they pay for new projects. We think 13% is the correct valuation metric, not the 5%. Time for a fresh look. I'm Simon Lack. We invest in energy infrastructure.